Imagine you're at a high-end party, holding a glass of $100 Napa Cabernet. The host looks wealthy, the estate is stunning, but if you peeked at their bank statement, you'd see a hole in their pocket the size of a crater. Today we're deconstructing Crimson Wine Group. On the surface, it's luxury and vineyards. Underneath, it's a masterclass in financial survival during a market that's suddenly decided it's too expensive to get tipsy. Welcome to the 2025 Deep Dive by HDIN Research. First, let's look at what they actually own. We're talking about 720 acres of prime dirt in Napa and Sonoma. In the wine world, that's like owning a few blocks of Fifth Avenue. They don't make Tuesday night pizza wine. They make I just got a promotion wine, the $16 plus a bottle stuff. The strategy? Rely on the fact that even if people drink less, they'll want the good stuff. It's a classic luxury play, but as we're about to see, even the best real estate can't hide a sales chill. Now here's where the record scratches. Sales dropped by $8 million. That's not just a rounding error. That's like losing the revenue of a mid-sized winery overnight. Why? Because the middlemen, the distributors, stopped buying. They've got warehouses full of bottles, and they're telling CWG, hold your horses, we can't sell what we already have. Plus, Canada, usually a polite neighbor, had a trade spat that wiped out over $1 million in export sales. The party just got a lot quieter. Here's the wait what? Moment of the year. Crimson reported a profit, but look closer. Their actual business operations lost nearly $4 million. So how did they make money? Simple. They got paid for being a victim. They cashed in over $4 million in insurance checks from past wildfires. Imagine failing at your job but getting a massive bonus because your house burned down 4 years ago. It's a paper profit paradox. It looks good on the news, but it doesn't pay the rent long term. So, is the ship sinking? Not quite. They're building a financial fortress. They have almost no debt, which is unheard of in this industry. They're pruning the vine by writing off bad investments, and they've just gone on the offensive by buying a massive Chardonnay brand called Raeburn. They're essentially burning the old furniture to keep the house warm while they build a brand new extension. Let's talk about direct-to-consumer, or DTC. This is CWG's secret weapon. When they sell a bottle in a store, they make a little. When they sell it directly to you via their wine club, the profit margin jumps to 66%. It's the difference between selling a lemonade for 50 cents on the street or $5 in a fancy glass at a hotel. DTC is the only reason this company isn't in a tailspin right now. Look at this table. It's a sea of red. Sales down, profit down. Operating income crashed by 300%. If you only looked at the net income at the bottom, you'd think they were doing okay. But the adjusted EBITDA, our fancy way of saying how much cash the business actually breathes, dropped by nearly 30%. The insurance money was the oxygen tank that kept them from drowning this year. Management finally admitted what we all suspected. Some of their brands aren't worth what they thought. They took a $1.3 million write-down. That's like finally admitting that the vintage car in your garage is actually just a pile of rust. It's painful for the ego, but it's great for the balance sheet because it clears out the bloat. They're facing reality, and in this market, reality is a cold shower. Here's a scary number. 685 days. That's how long their wine sits in a warehouse before it's sold. That's almost 2 years. Now, wine is supposed to age, sure, but your cash shouldn't be aging alongside it. If they can't move these bottles, they'll have to cut prices, and, in the luxury world, a sale is the first step toward losing your prestige. This is the liquidity trap to watch. While everyone else in the wine business is drowning in interest payments, Crimson is chilling. Their debt level is just 8%. Compare that to the industry average of 35%. They have what we call dry powder. They're like the only person at an auction with a suitcase full of cash while everyone else's credit cards are being declined. So what do you do with a suitcase full of cash? You buy a cash cow. They spent $35 million on Raeburn. Why? Because people are currently obsessed with super premium Chardonnay. It's a high-velocity brand that moves fast. They're using their pristine balance sheet to buy growth that they couldn't create organically. It's a bold bet in a nervous market. They're also pruning. They've put Double Canyon up for sale. In consulting speak, this is rationalizing assets. In plain English, it means, this isn't working, let's get our money back. They are focusing on the winners and cutting the losers. It's a classic McKinsey move. Be ruthless with your portfolio. Let's get serious for a second. Fire and smoke are the new cost of doing business in California. The insurance money we talked about earlier, that came from smoke damage. CWG is spending millions on water and forest management because if the trees burn, the brand burns. They aren't just selling wine, they are fighting a war against the climate. It wasn't just fires, they got hacked too. A data breach in 2024 has led to a class action lawsuit. In the luxury world, privacy is part of the product. If your customer's data is leaked, your premium image takes a hit. Plus, management lost their bonuses because they didn't hit their targets. When the captains aren't getting paid, you have to wonder how long they'll stay on the ship. So what's next? 2026 is the year of integration. They'll close the Raeburn deal, sell off Double Canyon, and try to turn that new Chardonnay into a cash machine. If they can clear the wholesale bottleneck by the end of the year, they'll come out of this luxury correction leaner and meaner than ever. Final verdict. Crimson Wine Group has done the hard work of cleaning the slate. They aren't hiding their problems anymore. They're writing them off. They have the best balance sheet in the business and a new growth engine. In a market full of distressed sellers, they are the tactical buyers. Keep an eye on them. If you want the full-page data pack behind this analysis, head over to HDIN Research. We deconstruct the numbers so you can understand the strategy. Drop your questions in the comments. Let's talk wine and wealth. Don't forget to subscribe. See you in the next deep dive.